So in this video I'm going to go through the solution to the question Listless Limited. This hopefully is one that you've already attempted, and just want to make sure that some of the differences between this question and the first question Kane Limited are pointed out. So you've got the projected balance sheet of Listless Limited as of 31st December 2019, and a pretty standard balance sheet. You've got your fixed assets, intangible assets, current assets, then the various liabilities. Total net assets of 971,000, and of course number of notes attaching to many of the items, which invariably have an impact on the solution. So in terms of starting the solution, I just show side by side the question and the template for the solution. It's easy enough to fill in most of the accounting book values into the template, with the exception of tangible fixed assets. All the other accounting book values just slot into the template directly, so it's perfectly fine to simply just enter these as is. There are no adjustments required for these. So you got your intangibles, you got your closing stock, so on and so forth, all exactly as per the question itself. So the first task, I guess, is to look at the accounting book value and tax-based value for the fixed assets. So just looking at the question sheet, we've got 900,000 accounting book values, note 1. So the tax and net book value details are as follows. This is the split of accounting book values, so that adds up to 900,000, and the tax written down values 500 plus 240 plus 55. Well, that slots in as tax-based value, so 795 goes into the tax-based column. Now, the accounting book value of the motor vehicles consists of the following amounts. So the 100,000 is split between commercial trucks and vans of 25,000 and passenger cars of 75. And as you can probably anticipate, it's the passenger cars that have an issue to contend with. So the note outlines that one of the cars is a Mercedes-Benz Saloon. Book value of it is 40,000. So book value of it is 40, and it originally cost 50,000. Okay, so originally cost 50,000, and when it was purchased. Okay, now as you know, that's straight away going to give rise to a difference for tax purposes, because the maximum amount allowed would be 24. So at the original date of purchase, the allowable amount for capital allowances was 24,000. So a relatively efficient car in that it got the maximum possible amount allowed for capital allowances. However, that gives rise to an initial permanent difference of 26,000, being 50 minus 24. That permanent difference, of course, as the previous video explained, essentially declines. Essentially, it's depreciated over time. So we need to modify the accounting book value to strip out the permanent difference. Remember that deferred tax must strip out all permanent differences. We only calculate it on timing differences or temporary differences. So that's my first working, and I'll just switch now to the solution. So I'm going to do it the tangible fixed assets working. So we've got the accounting book values as given. Okay, that's the 900,000 in total. No adjustment needed for the first two categories of assets. But for the motor vehicles, I have to take the permanent difference of 26,000 and scale it down. Now in the margin here, I have the text of the approach to doing this. So the original permanent difference was 26,000. The particular vehicle has a net book value of 40 at the moment. It originally cost 50. So it'll be 26,000 by 40 over 50. Okay, which is 20,800. And we just have to deduct that off the accounting book value to get an adjusted accounting book value. No changes to the first two categories. So to compare for capital allowance purposes, the adjusted accounting book value is 879,200. Okay, so 879,200 would be comparable to the tax-based value. So I'm going to slot that into my solution here. Now, just staying with that working one, the same idea can apply to industrial buildings. Okay, as you may recall from the previous semester, you don't necessarily get tax allowances on the full spend on industrial buildings, so you could have a permanent difference in relation to industrial buildings, and exactly the same principle would apply here. You'd have to calculate an adjustment to take off the accounting book value in order to arrive at an adjusted accounting book value. Okay, so going back now to the question. Okay, note 2 is about intangible assets that consists entirely of unamortized development costs. Okay, well, we've seen this already. Development costs are allowed on a payments basis, a cash basis. So you should recall that when you're doing your case 1 computations, you get to subtract the value of spending in the period for R&D. So that tells you it's allowed on a cash basis. And if something is allowed on a cash basis, its tax base value is 0. It's worth noting that not all intangible assets are allowed on a cash basis. For certain categories such as trademarks, brand names, you are allowed capital allowances for those, in which case you would have a tax written down value to slot into your tax base column. So don't assume that all intangible assets are tax base value of 0. It does depend on the specific assets. Okay, so continuing the entry into the tax base column. Inventory, there's never an issue there. Trade receivables, 86,000, and these are stated net of a general provision for bad debts of 1,000. Okay, that's a new thing. We didn't see that in the previous question, so I just want to maybe highlight that. Okay, so the thing about general provisions is, or the thing about bad debts, is that you only are allowed a tax deduction if the debt is specific. So a particular customer isn't going to pay you, you do get a tax deduction for that. Whereas with general provisions, you don't. So bad debts are allowed essentially on a cash basis, which is a slightly unusual way of thinking about it, but it is a consistent method in line with what we do with other assets. So the value then for the bad debt provision, the general bad debt provision, will be 0. Okay, so that gives rise to a difference between accounting book value and tax base values. So the 87,000 is the adjusted, so the tax base value versus 86, so there's a slight difference there. So general bad debts, I think the magic word there is general. Okay, that if it's general, the value is 0. So for tax-based purposes, so 86 and 87. Okay, so 87. Prepaid expenses, again, invariably we have to do some workings here. So just to look at the details of these. Okay, so prepaid expenses consist of the following amounts. You've got light and heat, pension premium, rental income receivable, and rental lease premium receivable. Okay, so again, for each of these, you're trying to figure out, are they allowed on an accruals basis or allowed on a cash basis? And quite a good way to think about these is, if doing a case 1 computation, do you have to add back any of these values because they are accrued? Okay, so if the answer to that is yes, then that tells you that they're allowed only on a cash basis. Okay, again, just think of the logic of that. You add back an accrued item because it is an accrued item, therefore it's allowed only when paid. So for light and heat, it's allowed on an accruals basis. Pensions, okay, well, very convenient. The question tells you these expenses are allowed on a cash basis for tax purposes. Okay, so cash basis. And in relation to the rental income, the rental income is taxed on a receivables or accruals basis. So both the income and the lease will be taxed when due. Okay, so they're allowed on a accruals basis, or they're taxed on an accruals basis. So the accounting book values were as stated. Light and heat allowed using accruals, which means that the tax base matches the accounting book value. Pensions, okay, allowed in cash, so that's going to be a 0. And the rental income, both items on an accruals basis, so the tax base matches the accounting book values. Okay, so we've got 6,800 for tax base versus 7,200 for accounting book value. Cash at bank, no issue. Trade payables, no issue. Accrued expenses, okay, as you might anticipate, there is an issue with these. So again, just looking at the rules on this. So accrued expenses consist of the following amounts. Wages, telephone and staff Christmas party contribution. So again, are these allowed on an accruals basis or on a cash basis, or indeed are they disallowed? Are they sources of permanent difference? So wages due, you should know that wages due are fully allowed on an accruals basis. So I'll just go to this. So these are my accounting values. So we don't add back staff wages just because they haven't actually been paid at the end of the year. Things like staff Christmas bonuses and just wages unpaid at the end of the month, they're not going to affect your case 1 computation. So they're allowed on an accruals basis. Same for telephone, there's no issue with those. And the staff Christmas party, equally fully allowed. So in this particular instance, there's no difference between the tax base value and the accounting book value. So 4,100 goes in for accrued items. Taxation due, there's never an issue, and loans, again, never an issue. Provisions for liabilities, you just need to check is there any note on these. So you've got provisions for warranty costs, 22,000, and provision for deferred tax, 1,000. So warranty costs are deductible for tax purposes on a cash basis, and again, that's pretty much universal, I believe. So cash basis, again, very helpful to be told that. Not all questions are so helpful in their information. So they're allowed on a cash basis. So you should then therefore be able to identify the tax base value will be 0 for the warranties. Okay, and the loans. So just 1,000 for the deferred tax. So the total differences then, when you add up the accounting book value versus the tax base value, total differences are coming in as 151,600, and the value of 12.5% is 18,950. Now again, I'll just emphasize that this is the desired closing balance, okay, on the deferred tax provision account. Okay, so I just want to underline the 2 words closing balance. So when I'm doing my ledger entries, subject of the next video, I will need to ensure that the deferred tax account has a closing balance of 18,950. So what I'm going to look at now in Listless Limited is the ledger account entries. So the relevant note here is note 6. The taxation due value consists of the following amounts. We've got corporation tax 1,000, PAYE and VAT. And the corporation tax balance represents an over provision. Okay, so over provision in respect of the previous year. The current year's liability is estimated at 20,000 and is to be provided for in your solution. So 1,000 euros over provision. Now again, my previous video described the idea of over and under provision. So over provision, we estimated that we owed, say, 10,000 euros in tax, and we actually only owed 9,000. So we over provided in the previous year. So this doesn't represent an actual liability of the company, and it's going to have to be cleared out. It has to be eliminated because the tax office isn't going to be looking for that 1,000 euros from us. It was just our calculation was off by 1,000 euros for whatever reason. And we also have to put in 20,000 into the current year's liability. So switching to the solution. So I can start by just putting in my existing balance, this is the over provision at this moment in time, and I also have the deferred tax provision. The opening balance was given in the note 7. Provision for deferred tax is 1,000 euros. So that's a provision is a special category of liability, so credit balance. So those are the two opening balances. So first thing I'm going to do is get rid of that over provision here. So get rid of that, so obviously I have to debit this account and we credit the tax expense account. Okay, so just to eliminate the over provision. So that kind of clears out the tax liability account. So the logic of that hopefully is apparent and easy to understand. Next thing is to put in the 20,000 that we reckon we owe. So we have to create a liability. So we're going to create a liability, credit the liability account, and debit the tax expense account. Okay, so 20,000. The other thing I will deal with is the deferred tax provision. Now, we saw in the previous video that the desired closing balance on the deferred tax provision account is now 18,950. Okay, so we have a liability going forward of 18,950. So we need to slot that in as a closing balance, 18,950, which means that there's a movement, an increase in the provision, goes from 1,000 to 18,950. So that's an extra amount of 17,950. That's just new timing differences. So we're going to credit this account 17,950 and we debit tax expense with the same amount, 17,950. Now the terminology for that's known as an origination of timing differences. But again, you can just simply call it new timing differences. Okay, so 17,950 is the movement, so increase the provision by 17,950 and debit the tax expense account. Now in this question we don't have anything like dirt credits or R&D credits or tax withheld on charges, so there's no entries for such items. So just to kind of balance off this account, okay, so the total there is 21. So obviously we have a nice closing balance of 20, which again is what we reckon we owe exactly. Okay, now remember there could be credits which would have an impact, either a positive or negative impact on that closing balance. In the tax expense account, okay, we just need to see what the value that will appear in our income statement is going to be. So that adds up to 37,950. So in the income statement, I will show a tax expense, basically the figure that is deducted from profit before tax of 36,950. And we've got this account already balanced off essentially. So there's my deferred tax provision at the end of the year. Final bit is the P&L disclosure, and there's a relatively limited disclosure that we can make in this question. This is done using the tax expense account. Remember, P&L tax charge is basically your tax expense account. So the elements that are contained within this account, which net out at 36,950, are disclosed in a kind of just tabular format. Okay, so just to show that, so we've got the tax charge consists of the following components. We've got this year's liability less an over provision from previous, so corporation tax expense of 20 less a prior year over provision, so that leaves 19, and then we've got that's the 20 and the 1,000 dealt with. We've got the extra 79.50, so that's origination of timing differences. Okay, 17,950, and that gives us the tax charge for the period. Now, it would in published financial statements also be given an indication of how these are consisting. So you'd need to have your case 1 computation, your tax return computation to give that detail. That isn't going to feature in such questions that you'll see in exams with myself or in the manual. The information just isn't provided in those questions. Okay, so that completes the entry there, and I hope that you found that useful.